Well, I think we are a few minutes in, so we'll just do a slow start with a few introductions, and then we'll crack into it, and you can teach the country about what we're talking about today. So, a little intro, obviously, Dylan and Grant here from Rethink Investing. I am the acquisition specialist for Rethink Investing, so working on finding and sourcing deals. And Grant here is on the advocate side, so he's working with investors to, what do you do, Grant? Hold their hand through the process, teach them about the process?
Yeah, effectively customer relations side of it, holding their hand, walking them through the process, their point of contact through the whole process, and trying to make it as stress-free as possible for them.
Yeah, nice. And then we have Steve here from VALUIT, so the founder and director of VALUIT. We snapshot on Steve.
Yeah, so I'm a registered plant and machinery valuer by trade, very different to land and buildings valuers. A land and buildings valuer is what most people know of. There's hundreds of them in the country, but there's 21, I think, registered plant and machinery valuers. So we're few and far between, and not many people know about us. But we work quite differently to land and buildings valuers in our style and method of valuation. So,
how did you get into plant and machinery specifically?
There is a degree course for it now, but believe it or not, I came in under the grandfather clause. So I was it was like an apprenticeship. So I just got a job with a valuation firm, and they had a plant and machinery division, and I just on the job training really with a guy that came out, had bought the industry out from England. So it's
part of the woodwork now.
It's been fun, but it's good.
Cool.
Nice.
Alrighty, clicking into it. So first of all, just to introduce a bit more about Rethink Investing and who we are, and then I'll hand over to you, Steve, to do a little bit about VALUIT. But Rethink Investing, we're originally an Australian company, and we've acquired over $6 billion over the past 10 years, and we opened up our doors in New Zealand about 2 years ago. You were actually at our launch, coming up to 2 years. Yep. And since then, it was a slow start as we got our sort of feet on the ground, and since then we've built up to just about 250 million in acquisitions over the past 2 years, and that now averages out at about $20 to $30 million a month in acquisitions of commercial property. And the spread is all the way from Invercargill. We've done some deals down in Invercargill, all the way up as far as Whangarei, so the full national spread. The business is like a three-pronged approach. A lot of listeners here might already be familiar with our style of buyer's agency, but we have three prongs. So we have the acquisition side, which is myself, out there looking for deals, talking with vendors, developers, agents, which perhaps means that I see more property than anyone else in the whole country, because I get direct to vendors, direct to developers, direct to agents, from as far south as Invercargill to as far north as Whangarei and above, but we haven't bought anything further north than Whangarei. Then we have the advocate side, as I said before, and introduced Grant. Grant's working closely on the relationship side with the investor, and that's the sort of the two faces from that side. And then we have the due diligence. So once the property goes under contract, we hand the deal over to DD, and they're there to check everything that I've basically pitched and proposed to make sure that it all stacks up. There's about 100 checks that they do to make sure that, as I say, what was presented to me in the first place and what I found on the high level DD is sure enough the deal that we're trying to settle. So that's a little bit about Rethink Investing, and we're getting around the country. So Auckland here, Grant's come up from Christchurch today, and we're getting around every other city sort of every second month. How about VALUIT, Steve?
Yeah, so I established VALUIT back in 1998. We do have national coverage, so I've got a team of people out there. Most of them have been with me a fair while. So our guy based in Christchurch, who covers the South Island, has been with me 25 years. Our Waikato guy has been with me 25 years. And our key admin lady, Raywin, she's also been with us 25 years. And she's really close to retirement. She's getting close to 80 now, but she's an absolute legend.
She's listening in now. G'day, Raywin.
No, she's not listening in. So, been operating since 1998. We are New Zealand's only specialist in the area of depreciation and purchase price allocations. So, as I said before, we're registered plant and machinery valuers by trade. That's what I am. And we only do depreciation work. So predominantly since 1998, most of our work has been for residential property investors, a little bit of commercial property. But since the PPA, which we're talking on today, since that came in, I've really been pushing the commercial side because there was just no one out there talking about it, no one educating. and my phone was going off the hook with people asking what they should be doing. So sort of pushing into that commercial side, and over the last 12 months, I've been back on the tools, out on the road, really sort of looking and trying to get my head around the commercial purchase price allocation rules, so that I can push things back out to my team, so that we've got things happening right.
Yeah.
So we've communicated with IRD around the new rules. IRD have been really good in talking with me, and I've sort of put some ideas to them as to how we could do things smarter or better, and to create a situation where it's I guess a win-win for vendor and purchaser. So yeah, been really excited about that. I spoke to the Law Society just over a year ago, their members, always talking to accountants. And the interesting thing is with accountants and lawyers, a lot of them don't understand the rules, and I don't really hold that against them, because accountancy and the legal profession is massive and they can't know everything. I don't know everything about valuing everything. So I do a lot of education to accountants and lawyers, and try to do it in a nice way. Often they've got some of the rules slightly confused, but anyway, that's me.
Yeah, good. Well, there we go. Got the New Zealand's only buyer's agents talking to New Zealand's only depreciation specialist. So
Sounds good.
That's a good mix. So before we get into PPA, and you can bring us on to that, just thought I'd give us a quick market update and a few current opportunities and pitfalls of what's going on in the market at the moment. So the New Zealand property market, commercial property market, has been the same as it has now for a little while. It's sort of bubbling along where it is. There's a lot of opportunities, but the economy in itself has kind of been pretty steady at the bottom, you'd almost say. And so we've been waiting for the upturn, and all of the things feeding into the economy to correct that, like the interest rates coming down, have been happening. But now it's going to be about a bit of a sentiment shift as to what changes the next forward propulsion will be just a sentiment shift into people now starting to move the economy along a little bit. Yields, again, it's always funny just after an OCR cut, suddenly vendors get all excited that the property prices have changed instantly overnight. It's not quite the case, but like everything is feeding in, there's an opportunity to do yield first investing, which is what Rethink focuses on. An opportunity to compound that income that you're getting, because now there's a difference, and you're getting a higher yield than in most cases you are interest rates. Interest rates are now, don't think it's going to be far away before we see 5 flat. We're in sort of 5.5 territory now, and so if we're picking up, our base is 6%. So if our base at 6% for a yield and a 5.5% interest rate, it creates that opportunity for free cash flow at the end. As we talked about last time, it's a net yield, so that's cash in your pocket. And the biggest opportunity at the moment is to let that money compound for you and work for you and get it back into the market to do other things. The buyers, so the current opportunities, it is a buyer's market at the moment. We're the ones that are out there. If you're a buyer out there at the moment, you've got the capital to be able to purchase property, it's a good time. What's important in a buyer's market is getting access to as many opportunities as you can, because there's a lot more opportunities out there. When the market heats up, as you guys know, when the market heats up, there's things are turning over a lot faster, and sometimes you're in the mix with a lot more people. Whereas now, if you can get the opportunity to see more opportunities, then you can, moving on to the next one, negotiate a bit harder, because you've got your eyes on more deals from the bottom of the south to the top of the north. Acting swiftly, though, like people still think that in a buyer's market, they don't have to be as urgent. They can sit back. But the best opportunity is to be different from the rest, in my experience. Like if you're in a buyer's market but acting still swiftly, if you see an opportunity, rather than delay on it, you jump on it quickly, then that gives you an opportunity to negotiate harder on price or other terms. So important to still act swiftly in that sense. And the other opportunity is, again, in my opinion, regional. The major cities, Auckland, Christchurch, haven't been affected as much with the economy the way it's been. Yields have been pretty steady. There's definitely been some movement, but there's some difference in the risk versus reward in some of the larger regional areas. And if you look at some of the tightly held markets out there, then there's an opportunity to buy with more rental increase that's coming. So pitfalls, I find it quite interesting to have a listen and a look at the contrasting perspectives with the news that's out there at the moment on the economy. Everything's pretty doom and gloom. And if you read sales agents' updates, it's almost the opposite. They're telling you that things are selling for 4% and they're flying out the door. So that compared to actually what's real on the ground is using the opportunity that you've got, having cash at the moment to buy, and using those skills for negotiating and acting swiftly to pick up some good opportunities. Auctions, what do you guys think on auctions?
Haven't been to an auction yet.
Yeah.
On commercial, it's hard to get the value.
Yeah. It's just unnecessary at the moment, to go to an auction at the moment. And the whole point in an auction is to drive excitement and get more people in there bidding to bid prices up. But in the market at the moment, you're better off most of the time if I see something going to auction, we'll sit there, tell them we've got interest, let it go through, and then get in touch afterwards. And if it's been passed in, then have another crack at it. And then, I think I said it before, the advertised yields that you can see from sales agents and just people, if you look on the market, look into news, you're seeing some pretty low yields out there. But in reality, we're buying at the 6% mark for good industrial stock in Auckland as an example. So just not being sucked into the advertised yields that are out there. But that's enough on the market update. Let's get into why we're here. So, Steve, handing over to you. Let's start with the crux. Let's start with this, the basic breakdown of what the PPA is.
So, look, the PPA is short for purchase price allocation, and it's really about making sure that a vendor and a purchaser have the same tax position. And it applies for commercial property to over 7.5 million. Residential property transactions over 7.5, commercial property transactions over 1 million. And really what it means is it was introduced in July 21. However, a lot of people didn't take a lot of notice of it because the depreciation rules were different at the time, and buildings were depreciable back in 2021. So what we used to see a lot of was PPAs going through with really limited information, but they still sort of met the rules at that point. So it was introduced by ID. It's about separating out the asset classes that make up the property for tax purposes, and it's as simple as that. So it's literally a purchase price allocation. What we produce as a PPA is effectively the sale price. It's just broken down into the various asset classes.
For being able to legitimately claim back on things that do depreciate on your building, so things that wear and tear or things that you are going to need to replace.
Yep. So look, depreciation's an allowance for wear and tear. That's what it is, and the aim being really is it's a non-cash expense, so you're not paying tax on that depreciation. And really, the aim is that money goes towards repairs and maintenance, right, to upkeep the property. The reality is that most people don't necessarily put it back into repairs and maintenance. It just becomes a tax break. But, it's legitimate. IRD have got a really comprehensive depreciation schedule, which we'll talk about a little bit later. But it's a legitimate non-cash expense. It's something that you're able to claim, and you're obligated to actually claim your entitlement, your full entitlement. And that's causing a lot of the problems with PPA at the moment, is a lot of people haven't been claiming their full entitlement. And so now that it's required to be agreed as part of a transaction, it's creating a lot of confusion.
It doesn't change the fact that down the track, we'll get into more of the weeds soon, I'm sure, but it doesn't change the fact that when you then actually pay for the items that you need to depreciate, you can still claim that as a cost on your building or your a cost against income.
Yeah, so it comes back to, look, once you buy the property, let's say it's got carpets, there's carpet there, you claim depreciation on the carpets. If you replace the carpets, then probably it's going to be a capitalisation rather than repairs and maintenance, depending on how quickly you do it. But look, at the end of the day, you get a write-off on the carpets that are there. You start claiming depreciation on the carpets that you've put in. Look, it gets quite technical, but the best thing to remember is that, people should be claiming their full depreciation allowance. It creates an incredibly big tax break, I guess, if you want to put it that way.
So you said 1 mil for commercial and 7.5 mil for residential. What happens under those limits?
So under those limits, you're not obligated to agree the purchase price allocation. So you can nominate your own purchase price allocation, and that's what we used to do. So our work was predominantly someone would buy a property, they'd come to us, and we would just split it down into all of the various IRD categories. What the vendor did, who knew? And that's really where IRD have brought this in, is they want people's tax positions to align. So what may have happened previously is a vendor sort of wanted their assets, like their buildings and all their depreciable assets, so things like carpets and curtains, they wanted those as low as possible when they sold it, so they didn't have to sort of pay any depreciation recovery or income on those assets. It's another technical aspect. But the incoming purchaser wanted those values as high as possible. So what we may have had is a situation where an outgoing vendor, we use carpets again, they may have had $50,000 of carpets in their accounts as a written down book value. So that becomes their closing book value. But then the purchaser would bring a valuer in. We might look at it and say, well, actually, they're worth $75,000. So there's a $25,000 difference just in carpets alone, and you run that across all the depreciable assets. So that's really what IRD are wanting to stop. And it comes back to identifying what IRD call the different asset classes. And there's more to it, but just from a purely property transaction base, there's really three asset classes that we're interested in. One is land, which is obviously non-depreciable. And then the other one is the building structure. That has been depreciable in the past. It's not currently depreciable. So that the depreciation on building structure was removed in April 2024. And buildings have been depreciable for the last 4 years. The Labor government actually reintroduced depreciation on them during COVID. And then the major asset class is depreciable assets other than buildings. And a lot of people, I was talking with Grant before, and he mentioned the term chattels, and so many people get caught up on chattels and think that it's just chattels. And, chattels are generally carpets, curtains, blinds, a few things like that. But depreciable assets goes well beyond that, and I will give some more detail on that a little bit shortly. So as far as why people should bother, is there really is, I guess, a misunderstanding around what can be claimed. And as I said, I'll cover that off, but also how value should be attributed. And a lot of people, because they're only thinking about chattels, they're putting really low values into contracts, if they do even list depreciable assets. And it's just a nominal value, and it's so far off the mark. And what it does is it sort of creates a neutral position potentially for the vendor, but a really negative position for a purchaser. Yeah. So we'll talk about that a little bit more as we go through.
So if you were to summarise it for the people here listening, assume they're all potential buyers. I think you said it a couple of times now, but why should they be interested in the PPA?
The reason they should be interested is, first of all, if they agree a PPA that's not accurate, they're going to be losing out on a lot of tax benefit, right? A lot.
We're talking a lot.
A lot. We are talking a lot.
We're talking 5 and 10 grand.
You're talking hundreds of thousands of dollars in tax. So that's really it. It's all about that. And then secondly is you want that information if you look to sell in the future, because these rules are in place. They're there. IRD expects you to follow them. So if you're not following them now, and you come to sell, an incoming purchaser is going to want that information. So if you don't have that information at that time, it could create some difficulties. Yeah. But number one, tax breaks, reduce tax.
Yeah, okay. Yeah. All right, well, I think that you guys both talk about this day in, day out when you're looking at different properties and deals, but rather than list all of the depreciable items, what are maybe the 5 that each of you have come across that are the most out there, not out there from a weirdness, but just out there in the sense that people, they aren't, because in the 250 million deals that we've now done, we've had one property that you've told me that had a fully comprehensive depreciation schedule that you said, leave it alone.
Yep.
It's perfectly fine. It seems like it's at market, leave it. So that's one property that was around about 7 million and 250 million. So I'd love to add up the total value in that whole 200 odd million that we could calculate that we've created. The IRD might not be overly stoked, but there,
Look, I don't think the IRD mind, because it's just about setting a fair tax position, right? And coming back, depreciation's about wear and tear. It's about allowing for wear and tear and therefore maintenance on the property, right? It's a legitimate expense.
It's going to be spent eventually.
Yeah. So What's your top 5, you reckon, Grant, that you've seen that most people are unaware of?
Well, I think it's, like you said earlier, people just get caught up on the chattels list. And 9 times out of 10, the PPA schedules that we get given provided by the vendor or their accountant is their depreciated book value on their chattels list. And they're missing at this. I guess the big ones that get missed off where there's usually a fair amount of value is hard stands, like car parks, partition walls. That seems like you'd think that's part of the building. You can't depreciate it, but that's a big thing that's pretty much never included. Things like electrical reticulation, plumbing fixtures and fittings, all those things that just don't fit under that normal, that's a chattel, what you'd expect from a residential property.
Yeah. I think too where a lot of people get caught is if you look at the real estate sale and purchase agreement, there's that little section there, Schedule 2, I think it is, whatever it is, of chattels. And chattels from a sale and purchase perspective versus chattels from a depreciation perspective are very different, and we need to stop using that term chattels when it comes back to depreciation, and we need to start talking about depreciable assets because that includes chattels. And I guess the big thing for people to understand is that the buildings or the building structure from a depreciation perspective is, and this is all clearly documented by IRD, the building structure is effectively the roof, the 4 external walls, and the floor. That's effectively it. So anything that holds the building up is deemed to be a part of the building structure and therefore non-depreciable. Everything else depreciates, right? So you've got land improvements.
A good, definition of it. Yeah. If it holds the building up.
Yeah. Well, I literally had an accountant ring me earlier today, and she said, look, just talking with this client and they want to know what's depreciable. And I said, okay, let's just talk about what's not depreciable, right? Yeah. Because it's 4 walls, a roof, and a floor is not depreciable. Everything else is, right?
Exterior paint.
So, no, that's part of the wall. Exterior paint is part of the wall. So let's not get too greedy. So if we look externally, it's land improvement. So it's retaining walls, whether they're concrete or timber. It's hard standings, as Grant said. So that's things like driveways. And if you think about a large warehouse with trucks going through, that can be millions of dollars of value in hard standings. It's big canopies outside. It's fences. It's tanks, water tanks. It's sewage systems, if there's sewage systems in place. Again, anything that doesn't hold the property up. So on a residential perspective or a hotel, for instance, it could be pools, it could be all sorts. If we then look inside the property, it's generally what we refer to as the chattels and the fit out, right? So building fit out. And where the term fit out comes from is there's a category within the IRD depreciation guide that's called building fit out. And so that's where things like electrical wiring and the walls start coming into it. But we also have fire detection and management systems. So that's all fire alarm systems, thermal heat detectors, smoke detectors, all those sorts of things, fire extinguishers, fire hose reels.
Like already you sound like it's complicated, right? Yeah. So how does instantly you're thinking of buyer, like what am I going to do? Go down there and say this is worth that, this is worth this is worth this. How do I know the list? You've told me they're scribbling down now what to remember, what not to remember. But that is what you do as a day in, day out job, is you're going in to value the depreciable assets within that building. Yep. So you're just a whole nother facet of purchasing a commercial property. You've got your normal valuer that values the building. You've got your building inspection that looks at the whole building, and then you've got a purchase price allocation specialist doing that valuation.
Exactly. And it's just something that people really have to be aware of, because if you don't get it right up front and you agree values that are incorrect, you're stuck with them potentially. And that's where in the past, a purchaser's gone to their accountant and their accountant says, hey, ring Steve from VALUIT and he'll do you a depreciation schedule. We can't do that now. We've got to go back and look at the sale and purchase agreement. And if there's a PPA in there, that's
why it's important to get it right.
Listing things that perhaps aren't accurate, we're a little bit stuck. So it's so important to get just the methodology even agreed up front. It doesn't have to necessarily be agreed as part of the contract, the values, but at least the methodology needs to be talked about.
So important point there then, and before we just jump onto this slide, I forgot, I always write at the top of my page and I always skip straight past it, but a little bit of housekeeping. So if you've got questions that are already starting to flow in now, chuck them in the chat. In the last 15 minutes, we're going to answer questions. We've already got a lot that were sent through prior to this. So we'll just, 5 minutes, we'll pause at the end and answer all your burning questions. But coming back to...
I'll just finish off on Steve's part there, because an important thing for our clients or people considering getting the purchase price allocation through Steve to note is when we present the PPA that we've been given by the vendors or their accountants to you, you will only, the morals behind you is you'll only provide a quote if you can provide value to the client.
Fully.
So yes, it might seem like, you know, $1,500, $2,500, $3,000 to get this report produced. But the timing of the report, when we usually know we're going to be able to satisfy DD before we order the report, so it's not effectively a sunk cost to our clients. But the value in the report that gets produced, even in the first year alone, far outweighs the cost of that report. So it's effectively a no-brainer. Like,
yeah. Well, I just signed off a job for you guys today, and you know, the initial value that the vendor had put on depreciable assets was really high compared to what we see, and it was $95,000. And we've come up with an additional $630,000 of depreciable assets. Wow. So the additional depreciation just in the first 12 months is around $70,000 in depreciation in the first 12 months, right?
So how does that
cost?
I think the report was about $5,000 plus GST. I know, it's so cheap, right? So cheap.
Yeah. Don't make it a percentage. Right? Keep it a fixed.
I'm not allowed to keep it as a percentage. It's under my code of ethics.
Okay.
So yeah, so look, it's really.
So how does that play out on a cash on cash basis? So the 680,000 that you've found.
Yep. Cash
on cash basis for the next however many years, what benefit in the pocket does a buyer see?
So let's just look at the first year. This client, I think it's $75,000 in depreciation in the first year. So that's a tax deduction straight away. So depending on their structure, whether they're a company or personal, well, you multiply that by the New Zealand tax rate. So let's say 30% as, you know, for ease. So, you know, there's $25,000 not paid in tax in the first year. And then that reduces slightly year on year. Yeah, it's worth doing.
It's definitely worth doing.
Yeah.
So moving on, like what's important now probably sounds like, wow, this is great in the buyer's favour. But we're not trying to make this heavily weighted in the buyer's favour, are we? So what are we doing to reach agreement and the reality of the situation? So for vendor as well as buyer.
Yeah, the interesting thing with the whole PPA is it was brought on by IRD, right? So they sort of said, look, we want this to happen. There needs to be some agreement, and they actually made the process pretty clear. And what they said is that if the parties can agree before settlement, great. If not, then the vendor's got 3 months to put the figures forward. At which point, the purchaser has to accept them. If the vendor doesn't do that, then the purchaser's got 3 months to do it. And if they don't do it, then IRD will do it. But IRD are a little bit more relaxed on that. And really their thinking is that if someone can get agreement, if two parties can get agreement, whether that's, you know, no matter when it is, as long as it's before a first tax return, if they can get agreement, that's cool. Because IRD, quite honestly, don't want to have to start getting these things done. So it's just really, you know, IRD had a really simple process in theory. The REINZ introduced an addendum for the PPA. So it's an addendum that goes into a sale and purchase contract. And it's about, I think, 6 to 8 pages long. I'm sorry, but it's horrific. It really is. And I'm pretty sure you guys agree. Yeah. It gives a lot of information, but without giving any information, and it certainly doesn't give any guidance on how to put the PPA together as far as the values. And the last page is literally a table which is blank with one column where you can write the asset class and a column where you can write the value.
Which is so common then to have just land, buildings, chattels.
Yep, or even land and buildings. Yeah. So one that has land and buildings is non-compliant with the Tax Act. And even one that just has a nominal value on chattels is also effectively non-compliant because it must be all depreciable assets. It doesn't, you know, the IRD doesn't in the Tax Act say some depreciable assets if you want to. It's all depreciable assets. So a value should be allocated to all of them. So the REINZ agreement is really hard to use. look, best practice is to get it agreed, the PPA, before settlement, if possible. And that's where you're agreeing effectively on those three asset classes I talked about, being land, building structure, four walls, roof and floor, and then depreciable assets, which is where your driveways and hard standings and walls and all that sort of stuff are valued. You don't have to list all those things separately as part of the PPA. You just need a value across each of those asset classes.
Such a difficult thing to do, though, to get it agreed before signing a sale and purchase agreement, because commercial property, well, just time wins all deals. So if you're there trying to do things by the book to get the best outcome, and then someone else comes in with an offer, not really understanding how the PPA works, and just sign something.
That's why you've been working on the wording to make it clear.
Yeah,
what's important, just quickly, is that, like you were saying before, that you found a benefit of $680,000 for that buyer. That did not in any way adversely affect the seller, did it?
No, it didn't.
No, not a single dollar.
No.
Yeah. That's what's important. So when we talk about reaching the agreement, we're trying to reach agreement for both parties without having an adverse effect.
And look, that's really where I've put all my energy into talking with ID, and I know we're going to talk about that in more detail. I've got slides on it, so I won't mention it now. But if we just go back one slide, the reality is that 95% of the PPAs I'm seeing are incorrect. I mentioned that the RANZ addendum is really unclear, and it is so confusing. Like, I can't understand it, and I'm in the industry. And so lawyers, accountants that are trying to put stuff together. And the hard thing for lawyers is that this has become an issue for them now, because it's something that's in the sale and purchase contract. It used to be something that accountants would deal with, at the first tax return. So it's really unclear. Often there's no mention of it in a contract, so you just sort of assume that the ID process takes hold. And what we're starting to see now is custom clauses being written by lawyers, which is nice, but generally those clauses put a massive, massive, massive burden on me as a valuer with time pressure. And they're asking me to do a PPA on a $12 million deal within 2 days, and it's just impossible. So, I think you just come back, and that's really where I've put a lot of work in creating this alternative wording, which just relieves all the pressure. And the idea is that it should actually be able to be put together by a vendor before a contract's even written up, so that it's all there, and then a incoming purchaser can see it, and there's no stress.
Yeah, because sometimes we've had to get you to make a call to the vendor's agent or solicitor to just explain, so that it doesn't feel like it's coming from a buyer's negotiation point, to explain we're not trying to do anything on the buyer's favour. We are buyer's favour, but without adversely affecting the seller, because that's a good deal where both people win. Yeah.
So what we're seeing at the moment is the most common scenario is what I call basically a win-loss scenario. And really, whether it's a win or a loss scenario, comes down to your advisor. And most often we're seeing a win for the vendor at the moment, and a loss for the purchaser. And it really just comes back to the fact that people are not understanding what depreciable assets are. They haven't done it right.
If you're involved, how is that occurring? Is this post?
I'm seeing them post. So this is what I'm seeing post, post agreement, or coming through as a proposal in an agreement. So really where it becomes a win for the vendor is where just simply their book values are agreed, right? So they might have a building value of 400,000 and they might have chattels of 5, right? So that just gets put in there, and land of 600. And a purchaser accepts that because they don't know. It sounds okay. They don't get any good guidance on it. And basically they're limiting their depreciation. Well, the other thing we're seeing is a vendor loss, where the vendor basically ends up with an increase in their value of depreciable assets. They end up paying tax on it, but the purchaser gets a heap ton of depreciation. Yeah. And it just doesn't need to be that way. There is a win-win scenario that's available.
Yeah. And so when you said before something's non-compliant, if a vendor does something that's non-compliant and it goes through, or it's not book value, what's the recourse again? Is it important for them to get it right from a legal perspective? Or is it more just sort of you're told rather than
it's just really important that all parties know what's going on and get it right. That's clearly the best scenario, because to get it fixed, takes time, right? And so let's look at a vendor perspective. If they sort of get their PPA put through and agreed by a purchaser, and one of the case studies is exactly this. 6 months later, purchaser looks at it. It's wildly, all values should represent market value, right? But market value to you is different to you, Grant, and different to me, and different to every listener, right? There's a range in there. But if it's wildly not, you can submit a request to ID to get things reviewed. Yeah. But, man, that just locks everything up. You can't file a tax return, right?
Oh, okay.
So if you can get that agreement, and this is where it's just about being fair and creating that win-win, right? So if we look at the win-win scenario, it's really where book values are agreed as much as possible from a vendor's perspective, but also for the purchaser that they've got the ability to claim depreciation on assets that are depreciable, but perhaps the vendor hasn't separated out from the building structure. Mm-hmm. So let's say a vendor's got, let's say they're not claiming any depreciation on depreciable assets. They've just got a building value, right? There's a heap of value in there. Let's say it's $1 million book value. The incoming purchaser, happy with $1 million, but they want to reallocate that value of $1 million across the building structure and then across depreciable assets. So very briefly, the book value for the purchaser stays the same at $1 million, and the vendor is at $1 million. So that creates a neutral position, but it's a win for the purchaser in the fact that they're able to reallocate the value of $1 million into depreciable assets. So the win for the vendor is they don't get hit with a big tax bill. Win for the purchaser is that they're able to break out that additional assets, separate them out, claim depreciation. And I've run that past IRD. And what they've said is that just because a vendor hasn't claimed their full entitlement, that shouldn't impact the purchaser. Yeah. So what they don't want is they don't want, a vendor's carpets being 25,000 and a purchaser's being 75, but the total value and the reallocation of those assets, so often if we see purchasers outgoing depreciation schedule, they might have air conditioning at 5,000 in there. We can have a look, and if it's 4,000, if it's 6,000, hey, let's just agree 5,000, right? That's just a process that I go through in my head, and we just put that 5,000 in. So again, it creates a neutral position. Yeah. It's about getting that additional stuff. Yeah. So I've been working in creating what I'm calling an alternative addendum. So it's an alternative to that REI and Z addendum, and it's really about trying to make it really clear, plain English, gives some guidance as to how these figures should be put together. Hopefully there's nothing new as far as terminology, but it's just a simple process, and it's a process of getting some agreement.
You don't want that to be like IP that you own. You want it to be in every single REN.
It makes my life easier when a contract comes in and they've got it there, right? Yeah. Because whether it says $35,000 in depreciable assets or $180,000 in depreciable assets, I still have to get involved to then break that $180,000 down into all of the various categories. So once you've got the PPA, it's all good to have that agreed, but then you've got to get the value out of that by having that value of depreciable assets broken down into all of the various asset classes, that's what I do.
It'd be nice to have it clear, wouldn't it? Because
very nice.
We can stop talking about it. Yeah.
So look, it might sound really technical and complex, and it is, but that's my job. Right, yeah. That's my job. Yeah. Your job as a purchaser, and your job as guys out there looking and doing the deals and doing the due diligence is to make sure that you're just not signing agreements that are going to restrict the purchaser. Yeah. And so many of them do. So all the technical stuff, that's up to me. As people investing, you just need to make sure that you understand you need to get PPAs looked at. If you're not doing a deal through Rethink, which surely you wouldn't be, don't agree a PPA without taking advice, and proper advice, not from an accountant or lawyer. Just ring me. Just ring me.
Well, we'll put your details.
I'll give you the advice you need. Yeah. So,
well, I suppose that it's important to have it just clear from the outset, and so you are just another tick box for the whole process to go. Like I was saying before, you've got your insurance broker that you go to rely on insurance. Your finance broker gets you the money. Your lawyer reviews the lim and the lease. The building inspector goes and checks the quality of the building, and then you're there for your part of that.
Yep.
You know? Yeah. Okay, time to just run us through some case studies. You've both got a couple of case studies, so I'll again hand it back over to you, Steve.
Sounds good.
You think you've got the first ones here, but let's talk about real life examples. You've touched on a few, but walk us through some of the stuff that it makes it easy. And one question that I had as well is that, for you to explain when you go through this, at what point do you provide the report, and what does the buyer then do with that report for these case studies?
Look, it's at the moment, I'll go through each deal because I'll sort of cover off at what point we're engaged. But, ideally we want to be right up front and not having to renegotiate. It just creates a nightmare. So the addendum that I'm looking to create is something that can be put together really at the time of listing. And that's something that I'm going to be working with agents on, is making sure that they use my addendum so that it's in the contract ready to go. And then a purchaser can see exactly what's been done, right? It creates a win-win. So anyway, so let's look at this first case study. So there was a vendor proposed purchase price allocation. And in this one, there was some value allocated to chattels prior to us taking a look at it. And when we really came down to have a look, it was nominal, right? So you'll see on the screen there, $35,000 was the value of chattels as proposed by the vendor, and they did provide a list. And in that list, it was things like air conditioning, floor coverings, and a few other bits and pieces, but nothing of significance. So what we did in this deal is we really renegotiated to allow the purchaser to separate out depreciable assets that hadn't previously been claimed. So, sorry,
I'll leave that with you.
Yeah, leave this with me. So the vendor proposed PPA was land of $790,000, buildings of 1.475, and chattels at 35,000. So if we flick over to the next screen on the case study, you'll see really what we managed to achieve. So we then looked to reassess the PPA. We reassessed the land at 717,598 as opposed to the 790. Now, for an incoming purchaser, you want the land value as low as possible. Chattels,
just on that, how do you come to the land value? Is that's based off the latest ratings valuation?
So really the land value, there's a number of ways. So it could be a market assessment by a registered land and buildings valuer, but most registered land and building valuations for commercial don't list a separate land value. What this is normally based off is it's a ratio between land and improvements based on the rating value. So if the rating value shows 40% as land value, then 40% of the purchase price becomes land value in effect. All right. So in this instance, 790 land value when we reassessed it was 717. Chattels 43,000. They had 35. Building structure of 1.3. Originally, it was 1.475. So building structure being non-depreciable, you want to keep that value low. So what we then did was depreciable assets that had not previously been separated from the building structure was 188,000, right? That had nil. So we've got the value of the chattels up from 35,000 to 43,000, and the depreciable assets that are not previously depreciated, so that will cover things like internal walls, plumbing, and electrical, was 188,000. So if you look at the impact down the bottom there for the purchaser, the depreciation in the first 12 months, based on the vendor's proposed PPA, the depreciation was 6,650, and then based on the negotiated PPA, it was $27,000 in depreciation in the first year. All right, so that's a pretty basic example, not high value, warehouse, pretty deal. Simple type property. Yeah. But, there's a big difference there between depreciable assets, right? Chattels, 43 versus their 35, and then $188,000 that they hadn't separated out from the building structure.
Just before you go on to the next case study, we're going to be cutting short on time. So
Yep.
I'm going to, you've been spoken a lot, Steve. All
Yeah,
right.
I'll speed it up.
No, we're going to cut, why don't we just cut to the second case study? Or,
Yeah, I'll talk through them really quickly.
Okay.
So vendor proposed PPA. There was no value to depreciable assets in this one. So this is quite key. It was a childcare facility, purchase price 5.8. So vendor proposed PPA, land of 580, buildings of 5.2 million. If we click over and see the results,
Wow.
580, we kept the land value the same. That was agreed, right? However, the building structure we brought back to 3.8. They had it at 5.2. There was $1.35 million of depreciable assets as opposed to none in the initial proposal.
And no impact on the vendor.
No impact on the vendor.
Yeah.
All right. And so the depreciation for the first full 12 months for the purchaser in this case was $155,000. So you're not paying tax on $155,000 in the first year.
Yeah.
All right. If we have a look at the third case study, this is one where this client actually came to us 6 months after the purchase, said, I don't agree with any of these values. Can you revalue the whole lot? And we're going to make a submission to IRD to get it reviewed. So the PPA that was in the sale and purchase agreement did have some items listed. Buildings at 250, air conditioning 1,600, electric gate at 15,000, driveways at 11, land at over 2 million. Now what they've done here is they've just basically used their book values on buildings, air conditioning, electric gate and a driveway, and then they've basically said all of the remaining value is land.
Yeah.
So when we've come back and looked at it, building structure 890, massive increase, air conditioning similar, electric gate similar, hard standings 123,000. So their hard standings, it must have been a repair that they'd done into the driveway. Land at 1.1, and we came up with depreciable assets of 224. So based on this, the vendor is going to have to explain their values because this is not something that was agreed, but it's wildly wrong. And so our client's now gone back to IRD and said, hey, look, the PPA was wildly wrong.
Yeah.
We've had it assessed. This is what it is. And for this client, it was
So even if
30,000.
agreed, there is a recourse.
Yeah,
if it's
there's what they call a Section 113. There is the ability, but it's not somewhere you want to go.
No, agreed up front.
Yeah, yeah.
And this is
And then
Grant.
case studies for here. This is
Grant's.
Grant.
Yeah, these are just a couple of relatively recent case studies we've had with clients. The first one, a classic case of the selling agent and the accountant just having, just not comprehending how a PPA is supposed to work. They said there was $38,000 of depreciable assets that was attributed to LED lighting. I think that was all it was attributed to. Dylan and I had some furious back and forth with how it should be
as we have been
presented. Even an easy Google Maps satellite view down, you could see the expanse of the car park space and the hard stands, and then brand new fencing around the property. So when without a doubt, there was more than 38 grand, and they said, no, this is what it is. There's nothing else. And we said, well, look, it's not going to affect your client's position. Will you allow us to get an asset appraisal done by VALUIT? And they said, fill your boots, it's a waste of money. And turns out Steve managed to find an additional just over $390,000.
I didn't find it, mate.
It was there.
Makes it sound like I made it up.
Yeah.
He found it.
The secret magic.
Identified.
Yeah.
And then the second one, brand new build, and again, just a non-compliant example. Really nice property, 3.2 million was the purchase price. Land at 1.2, buildings at 2 million, and nothing at all to depreciable assets. So that was pretty exciting. And in this case, the vendor was actually pretty good. We just said, hey, look, you're supposed to allocate to depreciable assets. Do you mind if we get the asset appraisal done? He had no dramas whatsoever. And yeah, $1,079,000 of depreciable assets for our clients. So a huge win off a very low cost.
Yeah. I love it. It's a no-brainer, like we've said a few times, because it doesn't impact the vendor, and there's a great opportunity for the purchaser. Which, historically, if someone has allocated values from a previous purchase, so they bought it and there was already a depreciation schedule of some kind in there, and then they just pass it on, and then you're trying to change it and there's a clawback, is that middleman stuck with an issue? Middleman, just the current landlord?
Yeah, look, every transaction is meant to be at market value, right? And what we're doing at the moment with this win-win is the purchaser's basically giving away value in the buildings, right, which are non-depreciable. So technically, there's some argument there that things aren't always necessarily market, but as I said, there's always a scope. But look, at the end of the day, you just take advice. People just have to take advice. It's as simple as that.
Yeah. Okay, whipping through this next section because we do want to have time for some questions coming up. But what's our next slide?
Yeah, look, so the next one, so if we can just get the slides flicked over for the listeners. No, we haven't got it there. That's fine. I'll talk to it. So this is about amending the PPA. So for properties that were purchased from 1 April 2020 through to 31 March 2024, right? So that's a 4-year window. And that was that 4-year window where depreciation for buildings was reintroduced. So for anyone that bought a building during that time and only land and buildings was listed in the PPA, which is the majority of the agreements, and they were sort of compliant because the aim is to separate depreciable assets from non-depreciable. Buildings were depreciable, right? Land is not depreciable. So they were sort of compliant. However, now that building depreciation's been removed, IRD is allowing people that purchased property during that period to go back and get a reassessment of that building value to break out the depreciable assets, which is great, right? That's really cool. And that's what they call a Section 113 request. So there is ability there. And look, again, if assets classes, you get a few months down the track and you just think this is wildly inaccurate, whatever's been agreed in the PPA, there's always the ability to go back and get it reviewed, forward evaluation to IRD and see where you go.
We were going to talk a little bit on the PPA from the vendor's perspective and on the selling side, but I think in reality we've kind of covered it. We're looking to find ways that it doesn't affect the selling side unless it is just wildly wrong, in which case we're trying to reset it to a market valuation for everyone. Then moving forward, we're setting a value on the depreciable assets at market value. So I won't dig any more. You want to add on that, Grant?
No, I'd say there's only been like a couple that have been wildly inaccurate. The majority of them, we just get like that depreciated book value of the chattels, and we know that there's plenty more value that can be extracted. So, it literally can be a simple win-win for both parties, and nothing to get too stressed out about.
No,
famous last words. I'm pretty stressed on it.
Yeah. You've been a busy man.
Tight time frames are the killer.
We've covered a lot that it doesn't impact the seller and how it can benefit the purchaser. But just to cap off on it before we sort of go into Q&A, what does it mean if we do change those values and it does have an impact on the vendor?
So look, if we do change the values from a vendor's perspective, then they may get hit with depreciation recovery. And all that is let's say their opening book value, I'm going to use carpets again as an example. So when they bought the property or they put some carpets in, it was $50,000. It's been depreciated. It's down to $15,000. If we revalue it and it's $25,000, then they're going to get hit with depreciation recovery on $10,000. So they will pay tax on $10,000 of income.
Is it something they'll receive an invoice from IRD?
It's just something their accountant does. But bearing in mind that we're not necessarily working with individual values. I've used carpets as an example. But, that might happen on the buildings. So if they've claimed depreciation on their buildings for the last 4 years while they were able to, if the building value goes above their book value, then they will have to pay some depreciation recovery on that. But hopefully they've made a massive gain on the sale of the building too. So the idea on our win-win is that doesn't necessarily happen, but where that can start to happen is where vendors are just flatly refuse to get into discussion. And
that's the worst bit. Like if they're just not engaging, then it's hard.
But so if I was a vendor and my carpet's 50,000 depreciated down to 15, and you came in and said, actually market value is 25, and I'm like, well, hang on a second, I'm following the IRD's diminishing value of straight line depreciation method, and this is what I've got to. What gives you the right to say it's now actually 25 and not 15?
Because I'm a valuer.
So the system is wrong.
No, look, and that may have been an extreme example because in my case studies, for instance, I think there was a figure where they had 1,600 and we came in at 18 or something like that. So, there's always a little bit of play. But that's where it's just about talking, and I'm a neutral party, right?
Yeah.
So if I know what their values are and they're within COE, then let's agree that, right?
Yeah. Because there are different
because
values.
there are differences, right? So let's agree it. So that's where, the example I worked on today where they had $95,000, that was their written down values, right? Well, when I did my assessment today, I came in at 97 or something and then pulled it back to the 95 so that it matched, right? So it is within COE, and that's why, before Dylan, when you said someone presented a really detailed depreciation schedule and I said, look, let's go with it, right? It's there. We could sit and argue the values all day. But
that's the big thing. You're not necessarily arguing the values. You're just finding things that they haven't depreciated yet.
That's the key,
That's the key.
Right? And for most people, 95%. Look, I've seen two in the last 3 years. I've seen 2 commercial contracts come through where people have been claiming depreciation based on their full entitlement. Right, that's 2. I see a lot of contracts. Right, so most contracts we can look to pull more value out of the vendor's buildings because they have elected not to claim depreciation on it.
Yeah. Okay, look, we're pretty much bang on time, although we were going to finish with 10 minutes still to go to do some Q&A. So we'll just grab a couple. We're going to chuck it on pause for a couple of minutes, read the questions in the chat and sort of compile a few. We might run over time by 5 minutes. You're not going anywhere, are you, Steve?
No.
Pub early?
No.
So give us a couple of minutes, team, and then we'll be back with some questions.
Okay, a few questions have come through on the chat. I'm going to direct them all at you, Steve.
Great.
And then we can go from there. Do you have details around the buildings that are depreciable in respect of rural property, such as barns and cow sheds?
Yeah, so buildings that are not depreciable are buildings with a lifespan over 50 years. So that's your traditional buildings that we're dealing with. But buildings that are depreciable, so things like glass houses, portable buildings, so insulated buildings, so things like cool stores that have got the steel with polystyrene in the middle, they're depreciable because they have a lifespan of under 50. So where we would put them into the PPA is they would be listed under depreciable assets. And that's why we've got to get away from chattels, right? Because again, it's buildings that are not depreciable and then depreciable assets. So that's where we would list those. So I don't have a list of those, but IRD has got a really comprehensive depreciation guide. I think it's IR 264 is the publication. And you can download that, and every asset, there's thousands of assets that are depreciable and they're all listed in there. So fill your socks, yeah.
Fill your boots. Is there a limited amount of time in which to get the depreciation chattels schedule after you've purchased a commercial property?
Not so much if you've got a value agreed on the depreciable assets, right? So if you've got a value, because you don't have to separate it out as in list individual assets, but if you've got a value agreed, let's say 250,000, then we can come in at any time to split that 250,000 down into the depreciable assets.
Anytime before a tax return?
Well, it'll be before a tax return. So the key is getting that value agreed, but the best way to get the value agreed is to get us in to do it, and then there's the value agreed. So if there's no agreement up front, but there's a clause within the contract that gives you time, then that's the time. IRD basically gives the vendor 3 months and then the purchaser 3 months after settlement. So there sort of is a limited time.
Yep, okay. Majority of these questions appear to have actually been answered in what you've talked about. They might have come on through early in the chat. So for those listening, there'll be a recording of the webinar, so you can go back and review it. But what do you do if there's no PPA in the sale and purchase agreement?
If there's no PPA, best not to just keep quiet, because if there's no PPA in the agreement and it's not talked about, then come settlement, the vendor can put any PPA that they want forward if they remember, if they think about it, which is not necessarily a good position to be in. So if there's no PPA, just raise it, have a chat, just say to the real estate agent, what's their position as far as the purchase price allocation, and then sort of have a look and take guidance.
Mm-hmm. Mm-hmm. There's a question here about Labor threatening capital gains tax on commercial and residential property. I think that's a deeper hole.
Yeah, that's a whole nother topic.
A whole nother topic.
Yeah.
So
Don't go into too wild up
that one.
this time of night.
What else have you got over there, Dylan?
Just a couple that came in earlier. If a vendor suddenly realises, so you get to the point that they've listened to this webinar, right, and they're now looking at the contract and they're going, I need to start depreciating quickly. Yep. Can they catch up by quickly putting in a depreciation schedule now into the contract?
Where's the contract at? At what point?
Well, for example, you're agreeing it now. You just want to
look. It can be agreed at any time, really, and that's the conversation with ORD. Is that if two parties can agree, they'd prefer that.
If they haven't depreciated anything for 5 years, can they suddenly catch up and depreciate it all?
No,
you can only do it for that year.
You can only, once you've set your tax position on commercial, you've set your tax position, right? So if you look, that's a question for their accountant, right? Because there's all sorts of.
Why haven't you been doing your job? Might be a good way
to
start.
Look, exactly. Why haven't we been claiming? Yeah. But again, as I said, don't blame the accountant all the time. Yeah. But no, look, you can't really go back and suddenly start claiming.
So best option for people with property right now that haven't been doing it is just to start now, get a value done, and start depreciating from this point.
Really talk to me. And then we can put the right questions back to their accountant. Yeah. Because once you've set that, if you've submitted a tax return, you've really stated your position. Okay. So there is provision if you just simply didn't know, you can go back to get things reassessed. But that's something you've got to do with your accountant, and that can raise all sorts of red flags. And look, it's.
There's a comment, more of a comment than a question in here. It is very much unlikely that the vendor is going to agree to the values that you put on it. Which, good point, but I think what we're trying to get across to people is we're not trying to put something onerous on the vendor and saying, hey, this is what you have to agree to, and it's going to affect your tax position and tough luck. What we're saying is, yes, you've done this. You've missed out on depreciating these assets. Just because you've missed out on it, the purchaser shouldn't.
And look, that's what I said before. If the vendor's book value is at $1 million for buildings, it's still at $1 million for buildings, right? Because that's what their book value is. All we're doing is reallocating those assets for an incoming purchaser's perspective, and that's what I've run past IRD. And that's what they've said is that a vendor's tax position and not claiming what they're entitled to do should not impact the purchaser. Yep. So the values are still the same. It's still $1 million. It's just a reallocation of that $1 million.
That comment right there is the reason we're here, right? We're trying to clear that up, that they will accept, because it's not going to be adverse on them. We're just trying to get a hold of what they haven't already done. So
I think every email that we're in communication with lawyers and stuff, it comes back, as long as our client's building value doesn't change. All good. And that's what we're doing, right? Yeah. And the way that I put the reports forward is that the vendor's closing book value in this instance is $1 million, right? But the purchaser's allocation is slightly different, but it still equals $1 million.
And this is why we keep asking vendors to give us their schedule so that we can make sure it doesn't. If we don't have their schedule, we can't make it not affect them. Yeah. Or when we do raise it, they'll say, oh, now I'm going to have a clawback. So if you give us that schedule up front, we can then match up. And again, so long as nothing's gone wildly wrong with their depreciation, then we're not going to affect them. We're just going to add more benefit.
Exactly. And I mean, I had a look a job that I've literally just done in the last couple of days. There was a value in depreciable assets. I could see that was entered into the books in 2020. They purchased the property in 2019. So there was and it was a 25-year-old property at the time. So that value is renovations that the landlord has done. So there was no fit-out value or depreciable assets value prior to this 95 being introduced. So that was just a small renovation that was done, right? So we left the 95, but we then pulled out And that was the deal I was talking about before. We then pulled out the 650, which was things like all the suspended ceilings and all the fire alarm systems, right? They're all depreciable assets, but the vendor had never separated them.
And that vendor was, they're happy. They've already confirmed that. Doesn't affect them. Go for your life. Fill your boots, as you said before. It's all good.
Closing book value stays the same.
The last couple for me, one is like, because I've been thinking about this one for me, but I've been thinking about a lot lately, is on new builds and developments. There's a huge opportunity. Well, not a huge opportunity, but there's an opportunity to look at your numbers on new build stuff and add that back in to affect the net yield that comes out the back end.
Bearing in mind too, with new builds, you've got the investment boost, right? So you've got an instant 20% deduction. So let's use $1 million for round term, instant 20%. So $200,000 instant write-off, and then the depreciation starts on the $800,000. So new property and huge, and new investments, new property. When you think 4 walls, roof, and floor, that's a small percentage of the total construction. Absolutely small. Especially in a warehouse with a small office. High-rise building, slightly different.
And stuff that we're looking at, that's, can you get the roof replaced before settlement? That's another one that's sort of like we're encouraging in the negotiations. Oh, there's a leaking roof, so we'd like you to replace that before settlement. So there's a new roof to be depreciated. Well, not the roof.
Doesn't
but
depreciate.
Use an example as a roof. But there are certain things we'll ask the vendor to do that is before settlement, and then that adds to the depreciation schedule to come down.
As long as it's not building structure like the roof is, but yes.
So lastly, just how do they get in touch? If you just got any more questions, but otherwise, how do they?
Look, there's a couple more that have come through, but all I'd say is, look, best next step, speak to this man direct.
There was an interesting one.
If you keep reading.
No, there wasn't. Oh, look at them all now. There was an interesting one I saw before.
Go on, pick out a few. We've got another couple of minutes.
No. Anyway.
Not going to pick any more out?
No, there was one that I saw before, which was a goodie, but I can't see it there. So,
your details are?
Look up VALUIT, VALUIT, www.valuit, VALUIT. No E in there. Don't ask me why. And there's plenty of information on the website. And you can make a commercial property inquiry directly from the website. Look, at this stage, advice is free. I don't want everyone ringing me tomorrow. But, also you can email me through the website. Preferably don't give me a call. Just because I'm taking a lot of calls. You just said earlier, just give me a call. I mean, just get in contact. So my email is steve.t@valuit. So it's steve.t@valuit.co.nz.
Or reach out to us and we'll pass details.
Yeah, these guys know how to contact me. So
All right, thanks everybody for making the time tonight. We'll wrap up there and see you another couple of months.
Thanks very much. Thanks, Steve.
Cool. Thanks for having me. Thanks for listening.